Hello, my name is Ryan, and today I will be going over research done on the two athletic apparel companies, Nike and Adidas. Accompanying me is Crystal Norris and Jason De La Riva. We hope that this information will help guide you in your investing decision. Adidas was founded in 1949 by Adolf Dassler in Germany. They are primarily known for their athletic equipment, apparel, lifestyle apparel, really just an all-around brand. It's one of the biggest athletic apparel brands globally. Their market presence is strongly established in the soccer industry, being the official manufacturer of sporting equipment for the FIFA World Cup and making soccer apparel and equipment for many well-known soccer clubs around the world. As of today, Adidas is the fifth most valuable brand in apparel. Nike, on the other hand, was founded in 1964 by Bill Bowerman and Phil Knight. Bowerman had a strong interest in shoes, and Phil Knight had a strong interest in manufacturing them, so they got together and eventually formed Nike, which has become the largest sporting apparel brand on earth, endorsing some of the biggest names in sports like LeBron James, Serena Williams, Tiger Woods. These endorsements have really launched them to become a household name, and I'd be surprised if you can find a professional sport anywhere without Nike branded all over it. Nike is, as of today, the most valuable brand in apparel. Key trends for the fiscal year of 2022. Adidas revenue grew by 6% and gross margins dropped by a small 1.1%. So on the surface, you can see that these numbers look modest and kind of reflect the choppy economic environment that companies are working with at the moment. However, if you look deeper, you can see net income from 2021 to 2022 decreased by 70%, which is definitely something to worry about. In the annual report, Nike's management emphasized that the lockdowns in Greater China, the termination of the Yeezy brand, and the overall tightening monetary policy, increased inflation, and even the war in Ukraine have affected them and their international operations. As for Nike, while the revenue grew by only 5%, the gross margin grew by 7.5%, which again, modest increases from 2021. However, if you look since 2020 and COVID-19, Nike has done extremely well. Revenue and gross profit both increasing by a generous amount. And I think it's worth noting that in the annual report for Adidas, their management team heavily emphasized the macroeconomic factors, the war in Ukraine, the lockdowns in China, and the Yeezy termination. And while the Yeezy termination is unique to Adidas, the others are not, and Nike has done well, or if not well, at least grown in spite of all these factors. And I think that's a testament to the robust business model and effective management, and definitely something to take note of. In terms of liquidity, as you can see on the right, compared to the industry, Adidas is just a little behind. And at the same time, a lot of these ratios do reflect how poor of a year that they had, with current assets dropping significantly. I think that their cash and equivalents from 2021 to 2022, I think in 2021 they posted around 1.6 billion in cash and equivalents, and in 2022 it's at just a mere 200 million, which, I mean, I say a mere, but that's still a lot. However, if you look at the year before that, it's something to worry about. Overall, we decided to say the liquidity is questionable and below average. It's not poor just yet, but if they continue in this direction, it could definitely become a pretty scary situation. For Nike, it's just about the opposite. The current ratio, quick ratio, cash ratio are all well ahead of the industry. While these numbers did go down just a little bit year over year, you can still see that they're in a healthy position. If they needed to meet their short-term obligations, they would be able to. And we decided to deem them as healthy and robust. In terms of debt paying ability, Adidas times interest earn ratio from 2021, I think it was around 17, and in 2022 at around just 4.85, which is a huge drop off. And I think, again, a lot of these ratios are going to reflect the poor year that they had. Their debt to equity ratio grew this year, and their debt ratio also grew. This year is the highest amount of debt that Adidas has held in the past 5 years, and we deemed their debt paying ability as skeptical. And it's worth noting that as Adidas is making a swing towards debt financing, rates are consistently rising. So as with other firms, we're seeing that they are taking a step back from debt financing. Adidas seems to be relying more heavily on it, which is worth keeping an eye on. In terms of Nike, again, as you'll see, it'll be a pattern that Nike is outshining Adidas over and over. Their times interest ratio remained somewhat steady, but debt to equity ratio and debt ratio both decreased. As I said before, I think Nike is making a turn away from debt financing and trying to rely more heavily on equity. As rates continue to rise and borrowing becomes more expensive, it seems like an effective management decision to be against debt financing, and we can see that in Nike's financials. In terms of profitability, currently, if you look at the numbers, it doesn't look too bad for Adidas. All small single-digit changes from the year before or from this year. But if you look at how much they changed from last year, you'll see that it's a pretty grim picture. Even from COVID, they have continued to decline. And overall, I think it's just pretty worrisome to see how they're performing currently, and hopefully they can turn it around. Nike, on the other hand, has shown that they are, again, just a robust business model and effective management. From 2020 to 2022, all high double-digit net changes, currently double-digit net changes. Year over year, you can see a small decrease in these profitability ratios, but at the same time, I think that these changes are what you would expect to see in a challenging economic environment. Whereas with Adidas, you can see that in their annual report, they put a lot of emphasis on these macroeconomic factors, but it just doesn't seem realistic that your numbers are this bad. You'd expect to see something like this, a decrease of 1.3%, a decrease of 1.1%, not a decrease of 114%. So I think that while Adidas is emphasizing these other factors, when you look at Nike, who is showing, modest numbers, you can see a much clearer picture of the economic environment and how it's affecting some of these massive organizations. In terms of investor analysis, year to date, Adidas, although it's grown by 28% or went up by 28%, I don't know how much that says when you look at how low the share price went. Over the last 5 years, it's down 20%, and when you compare it to the S&P, which has returned around 52%, this seems like a pretty, skeptical investment at best. For Nike, on the other hand, they have beat the overall market. In 2021 and 2022, you see a massive rise in share price and then a drop at the beginning of 2023. But I think that that's just sort of the movement of the overall market. It's still promising to see that Nike has returned more than the S&P and shows that they're probably not a bad decision if you do and decide to invest in them. For Adidas, I believe it's worth sharing more information on the Yeezy partnership. And the annual report, they gave it mention, but they seem to want to downplay it as much as possible. But they did say that in euros, they are expecting to see a 1 billion euro loss, which equates to around like $1.1 billion. Half of that is due to just lost revenues, and the other half would be the sunk cost of the inventory they cannot sell. And I don't think that this is going to be as small of an issue as they're sort of making it out to seem. Like I said, they put a lot of emphasis on the macroeconomic factors this year, but I think that the real issue that happened was the Yeezy termination. I think that really affected their brand image in certain parts of the world, and I think that it could be a huge shift in the firm's trajectory. As for our recommendation, if you couldn't tell already, it's Nike, and basically every single factor, Nike takes the cake. In terms of this year's results, quarter one showed a 4% increase from the year prior and a 16% increase in Nike's brand digital sales, which is the sector they're really trying to see growth in. It's more of a direct-to-consumer approach instead of supplying retail stores with their products and selling them through those outlets. Overall, Nike seems to be a much more robust business model, a more effective management team, and just a much more promising investment. If it was us, we would choose Nike. And yeah, we thank you for your time, and we hope that this helped in your future investing decisions.